What's going on? Alex here, and today we're going to talk about the 7 deadly tax sins of partnerships. We're going to take a look at some of the common blunders or mistakes that business owners make when they have a partnership for income tax purposes, which results typically in the assessment of penalties, interest, taxes, a lot of unpleasant stuff. Let's dive right in. Of course, I put together a handy dandy spreadsheet, as always, for you guys. And let's look at deadly sin number 1, which is failure to recognize that a partnership exists for income tax purposes. This is something we see quite commonly, and it usually starts off with my friend and I, or my buddy and I, or my girlfriend and I. And when more than one individual partakes in an activity with a profit motive, then the default treatment from an income tax perspective is that that is a partnership, which has its own income tax implications, meaning you have to file a separate tax return typically, and all of those other fun things that go along with that. But the problem is a lot of new business owners don't realize that. And more so, they don't realize it in time because they might get the feeling that, hey, my tax return isn't due until April 15th, so we're good. The issue is that the partnership return is typically due on March 15th for calendar year entities. So by the time you get to April 15th and start thinking about your taxes, you're already late on the partnership return, which is never good because there are all sorts of penalties that go along with that. And it all starts because more than one individual get together. They say, hey, let's take on this business venture, or let's see what we could do in this business. And they start working at it. And at that moment, in many cases, they've created a partnership. And that business entity needs to file as a partnership. And we've seen many examples where clients will come to us and say, hey, last year I was working with a buddy of mine and we were doing this and that and this and that. And we find out after we've extended their personal returns, so now we're, let's say, in August of the following year, and there should have been an extension filed for the partnership on March 15th, which can result in pretty substantial penalties. So the key here is to understand that if you are going to engage in an activity with a profit motive with one or more other individuals, even if you don't have an LLC, even if you don't have a corporation, even if you didn't get an employee identification number or EIN, in many cases, you have a partnership for income tax purposes, and it needs to be treated as such. We hear all the time after the fact that clients will come to us and say, hey, we don't really look at it as a partnership, or we didn't really plan to file partnership returns, or, hey, we're just using a few personal Square accounts, so nothing's linked to any business entity, so it's not a big deal. None of that matters, because when you look at the facts and circumstances from an income tax perspective, you have a partnership in many cases. Again, we have to take a look at the extent of the activity, what the activity was, the extent of the participation of each one of the partners. And that will allow us to determine if a partnership indeed exists from an income tax perspective, and then file the appropriate tax returns for that activity. But the fact that you didn't formalize a partnership, the fact that you don't have a partnership agreement, the fact that you don't have a business entity, you didn't register an LLC or corporation, none of that changes the income tax treatment, unfortunately. So it's substance over form, and it's facts and circumstances over what you want it to look like at the end of the day, because a lot of times we can't rewind to the prior year and fix the circumstances, right? So sometimes we have some flexibility after the fact, but in many cases, not all that much. So this is an important factor to understand, is that once that partnership exists, you typically have a filing requirement on an annual basis for that activity in and of itself. And then each one of the partners would receive a Schedule K-1, which denotes their share of the income and deductions. So for example, 50-50 partners typically would have a 50-50 share of the income and deductions, but not necessarily. Those two don't have to align. We're getting a little bit more in depth than we need to right now. But just understand that the first deadly tax sin of partnerships is the failure to recognize that a partnership even exists. So you need to tackle that up front, do a little bit of planning. If you're thinking about starting a business activity with at least one other person, then it's good to get a CPA involved beforehand, because it's good to handle this up front, then have to deal with the penalties and the notices and all of that other stuff down the line, because then it becomes way more expensive to deal with this from a tax perspective. All right. So that is deadly tax sin number 1. Let's move on to number 2, which is the incorrect reporting of income and deductions. And the example I included here is that each partner reports his or her share of income and expenses on separate Schedule C. In some cases, this is an extension of the first sin, whereas individuals didn't realize that they had a partnership to begin with. But once they're to the point where they have to file their tax returns, they'll say, okay, well, how are we going to report all this stuff, right? And let's say they still don't know that they need to file a partnership return. So some people will say, look, the partnership netted $100,000. Why don't you report $50,000 on Schedule C and you report $50,000 on Schedule C, and we'll call it a day. That is incorrect. That is not a proper workaround for failure to file a partnership return and report the income and deductions accordingly. So what you may run into in that case is that you have a partnership that's active for a number of years. You fail to file that return. So now there are penalties and interest being accrued for the fact that you failed to file those returns. Then you also failed to file the Schedules K1. So now you have additional penalties for every year that you failed to file the partnership returns. And they tend to increase on a monthly basis as well. So that is a twisting of the knife that occurs when you don't file the partnership returns. Then once these business owners come to the realization that they have to file partnership returns, what can happen is these Schedule Cs that they filed, the 1040s with the Schedule Cs that split everything 50-50, those returns now need to be amended. Not only do you have the expense of dealing with the tax notices from the IRS, you also have the expense of filing prior year partnership returns. Then you have the expense of amending your personal returns, because this Schedule C reporting is not going to fly. Now, we can't force our clients or compel our clients to amend prior year returns, but it's important to have a good starting point moving forward for any returns that will file down the line. So the incorrect reporting is something we frequently see, and sometimes we'll have clients come in and we review their prior year tax returns, and they'll have 3 years of this incorrect reporting in which they failed to file a partnership return and they split the income and deductions in a way that's incorrect on their personal return. So those are, in many cases, cleanup projects that can get fairly expensive fairly quickly. It's doable, it's fixable, but there's a good amount of work involved to catch everything up and to fix what was done in those previous years, whereas it would have been a lot easier to get it right from day one. All right, moving along. Number 3, paying salary or wages to partners. And that's typically done with Form W-2. And I would venture to say, in the world of income taxes, it's dangerous to use the word always or never or any of those absolutes. But I would venture to say that in 99.9% of cases, there's never a reason why a partner of a partnership should receive a W-2 to report wages. It's just not done because for partners, they're typically owners. They have a flow-through percentage of the income and or deductions that are allocated to them per the partnership agreement. And they can also have what are known as guaranteed payments, whereby instead of just let's say a 50% profit share that goes to a particular partner, you could say, regardless of the income of the partnership, this person gets $100,000 a year. And then maybe they can get the percentage on top of that of the net income. But they are definitely going to get that $100,000 every year, no matter what. That's their guaranteed payment. In many ways, it works like a W-2, you can say, but there are no withholdings on it. it's reported on the Schedule K1 instead of the W-2. And again, if you're reporting this on the W-2, then you're now creating a situation where you're withholding the income taxes as the partnership, and then you're issuing a W-2, which is incorrect to the partner. So again, this creates a lot of issues that have to be undone so that everything is done correctly from an income tax perspective. And this could create a real mess, especially if you have the flow-through income, you have the W-2 income. Now it's affecting the personal returns along with the partnership. So sometimes amendments need to be filed on those ends, plus amendments for the W-2. So now you have income taxes that need to be fixed, payroll taxes that need to be fixed. Avoid the hassle. I would say there's never a good reason to W-2 your partners. If anybody could think of one, drop it in the comments below. But I would say that if you see wages going to a partner, then it's most likely incorrect. But it's an issue we see a lot. It's a common mistake, unfortunately. And it's not a workaround to properly reflecting guaranteed payments on the K1 and filing the partnership return. So you can't just W-2 everybody and call it a day. Okay, moving along. Number 4, top deadly tax sin of partnerships: failure to adopt a comprehensive partnership agreement. One of the main benefits of partnerships is the flexibility. If you have 5 partners and each one owns 20%, you don't have to allocate the income 20% to each partner. You can make it flexible. You can come up with all sorts of formulas to allocate the income. And more so, the deductions don't have to follow the income allocation. So you can have one partner owning 20%, being allocated 10% of the income, and being allocated 5% of the losses. You can do that. You can have immense flexibility with partnerships. It's one of the main benefits. But what can happen is this becomes a real mess when there is no partnership agreement in place. Because when it comes time for us to prepare the tax returns, and there's 5 partners, first of all, they typically have no idea who's the tax matters partner or the main partner with whom we'll deal with to discuss income taxes. Once they figure that out, the next problem is, well, what does the allocation look like? And at that point, you'll have many of those business owners start to negotiate what that should look like. Well, you should get this percent. I should get this percent. I need this much to offset my losses from other investments. I need this much to offset my gains on those investments. So the negotiation process begins when it's time to file the tax return. That is not the time to come up with a partnership agreement and start allocating the income and the losses and so forth. That's way too late. And a lot of the partnerships that we see come through from prospective clients, they don't have the formal partnership agreement in place. We always ask to see it along with the prior year returns. And you'll be amazed how many partnerships there are that don't have the partnership agreement. So how are they allocating the income and losses? Sometimes it's arbitrary. Every year it's different. Okay, so if you have a partner who has massive amounts of income and they have a huge tax liability, they just shove all the losses to that partner to offset their gains from other sources to minimize their taxes. So they're doing tax planning off the cuff on an ad hoc basis. Not a great way to go about it, because if the IRS was to look into this situation, they could make the case that the allocation was incorrect and everyone will have to redo their taxes. That doesn't sound like fun. That's one aspect of not having a partnership agreement in place, is you create ambiguity where there doesn't need to be any. And you may have partners start fighting over the losses or fighting over the income because they're trying to achieve a tax effect on their personal returns by allocating the income and losses from the partnership. So if you have partner A that really wants the losses and you have partner B that really wants the losses and you have no partnership agreement in place, good luck with that. Because to work that out can become extremely difficult, especially if both partners have an equal ownership percentage of the business entity. You can imagine how that can get ugly. The other aspect is that just like some marriages out there, because partnership is like a marriage, you're getting into a pretty close relationship with the people you do business with. At the beginning, they get along, but as time goes on, they start to get along a little less. And eventually, there's a rift that forms. So you have partner A that hates partner B. Now they're not talking to each other anymore. We've seen it. And at that point, the question becomes, all right, well, we need to file the partnership return. Who's allocated the income and who's allocated the losses? Now, let's say partner A is the one that contacted us. He'll say, oh, well, the partnership had a lot of income. Allocate it all to that partner B. I don't want any of it. Okay. Well, partner B is not going to be all that happy when he sees the K1 from the return filed by partner A, because he'll say, wait a minute, I shouldn't get 100% of the income. That's not what we agreed on. But the problem is there's no partnership agreement. So it's partner A's word over partner B's word, and it can become a real mess real fast. Moral of the story is, if you're going to get into a business relationship with somebody, make sure you memorialize the agreement up front so you can save the headaches down the line, because we see this way too often. So the two basic situations that you can encounter is the partners are friendly with each other and they don't agree, or they hate each other, they're not talking to each other and they don't agree. That's when we pull out the partnership agreement. And if there isn't one, then good luck with that. There's probably going to be some lawyers involved in many of those situations. So we're about halfway through the 7 deadly tax sins. I see some people watching here. If you're enjoying the video, smash that like button. Subscribe to the channel if you haven't subscribed already. I know a lot of you haven't subscribed. And with that, we'll move on to number 5 of the 7 deadly tax sins of partnerships. Failing to track partners' basis. Okay? Now, I touched on basis in the S Corporation tax sin video that I did, linked in the comments below. And basis can be described as the skin in the game that you have as a partner. So if you were to put in $1,000 as an investment in the partnership up front, then your basis would likely be $1,000. Similarly, if you have income allocated to you of, let's say, $100,000, your basis would increase by $100,000. So why is that important? Well, one of the reasons is that if you're allocated losses, one of the limitations that you have to contend with is having adequate basis in your partnership interest to actually be able to use those losses on the personal return. To continue my previous example, if you invested $1,000 plus you got $100,000 in income allocated to you as a partner, you have $101,000 in basis, let's say, in very basic terms. It gets more complicated than that. But if you're then allocated $200,000 worth of losses, you'll be limited to the $101,000 basis in terms of what you can deduct on your return in the current year. The rest of the losses will be carried forward, suspended for the current year and carried forward so you can use them in a later year. But if you're anticipating that you're going to be able to write off the full $200,000, then you got another thing coming. You're going to have a nasty surprise on your taxes, especially if you've underpaid your tax liability, assuming that the full amount of the loss would be available to you in year one. So the moral of the story is you have to track basis. Now, there are other limitations that come into play. You have at risk, you have basis limitations, you have all sorts of other things that come into play that limit your ability to deduct losses. But basis is certainly one of them. And I can't tell you how many partnerships come through and the partners have no idea what their capital accounts look like on the accounting side. They have no idea what their basis looks like on the tax side. And we have to recreate years and years of accounting records in many cases to get to the point where we can figure all this out. Now, in some cases, we can kind of back into it as accountants. We can be clever in this, in coming up with a basis where there isn't any of that information available. But it's better to have it tight and done from day one. Okay. The other thing is if you go and sell your partnership interest, let's say for $1 million, that amount is typically compared to what your basis is in that partnership interest. So if your basis is $101,000 and you sell it for $1 million, you're going to be looking at a gain of right around $900,000, be $899,000. But if your basis was $800,000, you sell for $1 million, then you got that $200,000 difference to deal with. But if you don't know your basis, it's in many cases assumed to be zero. And that could be problematic because you'll be paying more taxes than you should simply because you didn't track a number. All right. Difference could be hundreds of thousands, if not millions of dollars for not knowing basis. All right. So this is another common issue that we see all the time, and it can be easily avoided just by knowing that that's necessary and keeping it done from the beginning. All right, moving along. Let's take a look at number 6 of the 7 deadly tax sins of partnerships. Commingling of personal and business income and expenses. Honestly, I don't know why this is so prevalent with partnerships. I would say out of all the business entities, the partnerships are the ones that have the most commingling that I see in my practice, at least. And what happens is that a business has a business bank account and a business credit card, which the partners use as their own personal piggy bank. The issue is that it throws off the accounting now. Instead of having $100,000 in income and $50,000 in deductions, we might actually have $100,000 in income and $10,000 in deductions because a lot of the so-called expenses are actually personal expenses. And they either don't belong in the partnership return or they belong in an entirely different place from a tax perspective, and that is known as unreimbursed partner expenses. That's a whole different discussion. But know that when you commingle the personal and business side of things, the accounting can get messy and then the tax reporting can get messy. In addition, you might also have partner draws that are taken out of the business by a particular partner that exceed their basis. What can happen? A taxable event. Just by having your personal expenses paid at the partnership level, you can have gains that you're then subject to at the individual level simply for using that partnership account as your personal bank account. So you got to keep everything separate. You can't commingle this stuff because it's going to increase your accounting fees. It's going to increase your tax compliance costs because as tax preparers, we don't like to sit there and spend time trying to figure out what's personal, what's business on each expense line item. You're going to get billed for it. So if you have it tight from the beginning, if you have everything separated and clear and clean, then you are going to be looking good in terms of filing your partnership and personal return. But if everything's a hodgepodge, then first of all, expect to go on extension. Second of all, expect your tax compliance costs to increase along with your accounting and bookkeeping fees. And third, just avoid this altogether. All right, let's look at the final deadly tax sin of partnerships. Can you figure out what it is? Some of you guys are tax pros. I see you guys watching. So in that case, drop it in the comments below real quick what you think number 7 is. Number 7 is failure to elect out of the BBA, Centralized Partnership Audit Regime, or CPAR. What am I even talking about? None of that made any hint of sense. Okay, let's look at it piece by piece. BBA refers to the Bipartisan Budget Act of 2015. Now, don't fall asleep on me yet. We're not going to talk about it in depth. Okay, stay with me. That act had a piece of legislation included in it that can best be explained with a bit of a history lesson. Not too much, don't worry. Now, one of the crucial aspects of partnerships is that they're a flow-through entity, right? So you have income that happens at the partnership level, but it's typically not taxed at the partnership level. It flows through to the partners, and then it's taxed on the personal return. So very simply, if you have net income of $100,000 at the partnership level, the partnership pays no tax at the federal level at least. But if you have 4 partners, each owning 25% and each being allocated 25% of the income and losses, then each of them will have $25,000 in income, which will be taxed on their personal return. Now, what's the issue? Well, the IRS was having a lot of trouble auditing partnerships. Why? Because if they determine that partnership ABC understated its income by $1 million, increasing the partnership income didn't do anything because they had to then pursue each individual partner. There could be thousands of partners and increase the tax on each of their individual returns. Can you imagine? You have partnership ABC has thousands of partners. you've come to the conclusion that they've understated your income, but your job hasn't ended as the IRS. It's just begun, because now you have to go to partner number one and say, hey, this extra income that you're allocated, how much does that change your return? Then you have to go to partner two and do the same thing. So the IRS found that it was basically impossible for it to audit large partnerships, because it would just be assessing the additional amount of income at the partnership level and then losing itself in the pursuit of the individual partners. So this became more of a hassle than they can handle. So they said to Congress, listen, we need something better. We need something simplified where we can just go to the partnership and say, look, you understated your income by $1 million. So what we're going to do is assess a tax at the partnership level based on that $1 million. And they're going to use a high tax rate. Okay? After that, they're going to make the partners work out how they deal with it. Right? So those thousands of partners, they can figure out how they approach this, because we don't have to pursue every one of them. Instead, we're just going to say, look, partnership ABC, you understated your income. Here's your additional tax. Figure it out. And that was a way of increasing tax enforcement, because now you didn't have to do thousands of individual audits. You could just do one and call it a day. That's how we get the BBA, Bipartisan Budget Act of 2015, Centralized Partnership Audit Regime. And there are some severe limitations that go along with CPAR rules and regulations. And one of those limits your ability to file an amended partnership return. Now, typically, you would just be able to file an amended Form 1065 and call it a day. Not too difficult. But if you're subject to the CPAR rules as a partnership, then you have to file an administrative adjustment request. It's super involved, unnecessarily difficult and cumbersome, and if you're having a professional do it for you, expensive. And there's all sorts of other limitations that come into play. For example, penalty abatements that are typically available outside of the centralized partnership audit regime are no longer available under CPAR. So it's not a great place to be if you're a partnership, because now your hands are tied behind your back in a way, and your options are severely limited. But the powers of the IRS to assess taxes is substantially increased. So part of those rules that were established in 2015 included a way out for some partnerships. If you meet particular requirements, you can elect out of CPAR. You can literally go, not for me, I'm out of there. And that election has to be done on an annual basis. And for partnerships that qualify to elect out of CPAR and that make a timely and proper election to opt out, they're not subject to those rules whatsoever. It's as if CPAR didn't exist. That can be a huge benefit, because if there's an issue on that return, you can simply file an amendment. You don't have to petition the Supreme Court to change the number on your tax return. Okay? That's another significant aspect that is missed on returns that are filed by a lot of professionals even, but especially of business owners that try to file their own returns using something like TurboTax, let's say. They come to us and they need us to file an amendment. Well, we can't. Now we have to request an administrative adjustment. We have to file an AAR. It's a whole process, super involved in and of itself. Could have easily been avoided if they just checked the box to file an election. And this needs to be done, again, on an annual basis. A lot of partnerships forget about it. And that's why it's one of the 7 deadly tax sins of partnerships. All right. Well, if you're still around, you made it to the end, feel free to smash that like button if you found this helpful. But you know we always go above and beyond here, right? So this video is no exception. So I couldn't just keep it to 7 deadly tax sins. I'm gonna give you guys a little bit extra. Okay? Let's take a look at deadly tax sin of partnerships number 8. Failing to properly allocate liabilities among the partners. What are we even talking about? Failure to properly allocate liabilities among the partners. So this goes back to our conversation about basis and about deducting losses. And when you're allocated liabilities, again, this area can get super technical. You can have a college course about this. But long story short, if you're allocated certain types of liabilities as a partner, then that can free up your ability or increase your ability to deduct losses, to take distributions and not be taxed on them, or draws, whatever you want to call it. And it's extremely beneficial from a tax perspective in many cases to have that allocation occur. So there's a few different groups of businesses when it comes to deadly sin number 8. Some of the partnerships that we get that come on board have no idea that they could even allocate the liabilities. The second group allocated the liabilities, but they did so incorrectly because they didn't distinguish between recourse and non-recourse. Again, what that means is possibly the subject of its own video. Doesn't matter. But you need to separate out recourse and non-recourse liabilities and allocate it to the partners accordingly. Or they haven't updated their loan amounts on the balance sheet. Okay, so that $1 million loan from 10 years ago is still $1 million on the balance sheet, even though they've been making payments throughout that time. What happened to the principal? Why is it still the same? All right. So you have to properly adjust those loans on an annual basis, or at least check them to make sure that you're on point, that you're not reporting inaccurate numbers. And it goes back to the accounting. It goes back to keeping the financials tight from day one. That's going to help you in so many ways, and this is just another one of those ways. So failing to properly allocate liabilities is a huge issue. You have to know the difference between recourse and non-recourse and allocate it accordingly. And it doesn't hurt to incorporate all of this into the partnership agreement as well, so that it's formalized, it's memorialized, and everybody's on the same page. Because you don't want to have to argue about this stuff. You'll be amazed. Partners that love each other on day one are fighting like cats and dogs on day 365. So having this on paper can certainly be helpful. And in many cases, you won't even anticipate when it's going to come into play. So it's kind of like a prenuptial agreement in many cases, in which case you can protect yourself. All right. So with that, if you found this video helpful, beat up that like button, subscribe to the channel, hit that bell icon to be notified of future videos because they will be coming, and leave some comments, questions, concerns, and viewpoints, because if you ask an interesting question, I might answer it in a video just like this one. And with that, as always, hopefully this was helpful. Thanks for watching.